Imagine this: China shuts the valve on rare earth exports. Washington responds with new tech bans. Wall Street laughs it off, until the US dollar starts to fall. Not by a little, but relentlessly. 5 months straight. And then the panic sets in. Not with tanks. Not with sanctions. But with a spreadsheet. This is the story you're not seeing on the headlines. A quiet financial war, where spreadsheets are weapons and bond markets are the battlefield. Today, we break down the shocking moves the US just made, the eerie silence from China, and the very real possibility that the global economy is heading toward a storm, and the first domino to fall may be the US dollar itself. So here's the question: what crashes first? Trade, trust, or the entire global financial system? Smash that like button, subscribe for more unfiltered economic breakdowns, and don't even blink, because this episode might change how you see the next 5 years of global power. It all started with a bluff. Or at least that's how the markets saw it. In May, Donald Trump claimed he had struck a backroom deal with China. According to him, Beijing was on the brink of collapse, civil unrest, factory closures, and economic chaos. But no proof. Zero evidence. In fact, Bloomberg and Chinese government data show the exact opposite. China's industrial output actually rose by 6.2% year-over-year in April. Then, out of Geneva, came a surprise: a 90-day truce. The US agreed to suspend some tariffs, reducing duties to 30%, and China responded by lowering its own to 10%. It was supposed to be a win for diplomacy. But behind the scenes, Washington was playing a different game. Almost immediately after the handshake, the US Commerce Department slammed China with sweeping new tech bans. Not just on hardware, but on chip design software, semiconductor chemicals, and even revoked previously granted licenses. Reuters confirmed it. Licenses were valid one day, gone the next. This wasn't a pause. It was a pivot. And while Washington calls it a containment strategy, Beijing's response has been nothing. Not a word. Just a cold, calculated silence. Strategic ambiguity. But what if silence is its own signal? You see, part of the Geneva deal required China to ease its controls on rare earth exports, those crucial minerals that power everything from smartphones to fighter jets to AI chips. But as of mid-June, according to CNBC, those shipments still haven't resumed. US Trade Rep Jameson Greer admitted as much: "We haven't seen the flow." China's Ministry of Commerce responded by defending the delay as a routine dual-use review. But nobody's buying that. This isn't bureaucracy. This is leverage. And while Wall Street laughs and hedges, something bigger is happening beneath the surface. The S&P 500 bounced 2.1% on May 28, right after Trump delayed a planned 50% tariff on European imports. Classic pattern. Threat, dip, delay, rally. Financial Times even coined a term for it: the Takeo strategy. Trump talks tough, markets crash, then he backs off, and stocks recover. Investors started trading on that pattern, assuming it would repeat. But what happens if this time he doesn't blink? Moody's just downgraded the US credit outlook due to fiscal volatility. That's not politics. That's Wall Street quietly losing faith. And the data tells a darker story. US goods imports collapsed by nearly 20% month-over-month in April, the sharpest drop ever recorded by the US Census Bureau. And with that, consumer spending, the heartbeat of American GDP, barely moved. 0.1% growth. That's stall-out territory. Households are pulling back. Inflation sits at 2.3%, but people aren't buying, they are living off stockpiles from Q1. The tariffs intended to punish China. They are now hammering US demand, domestic production, and retail supply chains. Meanwhile, exports are down too. So the entire liquidity loop is breaking down. Let's talk about the dollar. Since peaking in December, the US dollar index has fallen nearly 5%. If June closes red, that'll mark 5 straight months of decline. And we are not just talking about valuation, we are talking about belief. The Institute of International Finance reports that foreign holdings of US financial assets now top $7.5 trillion. Most of that from Asian central banks and funds. For decades, trade surpluses were recycled into buying US Treasuries and blue-chip stocks. But with Treasury yields now volatile, and faith in US fiscal policy collapsing under the weight of partisanship and erratic trade decisions, even the stickiest of foreign investors are pulling back. And here's the irony: a weaker dollar should boost exports. But exports are already down. So there's no upside, only erosion. The illusion of strength is just that, an illusion. Washington is now in a credibility crisis. Wall Street's bets are being priced on the assumption that Trump always folds. But what if this time, the goal is to break the cycle? If Trump decides to hold the line, then every investor betting on his reversal gets left exposed. The market isn't just reacting to tariffs, it's reacting to confusion. So what does that mean for capital? If the world stops believing in the US as a safe haven, the entire architecture of global finance begins to shift. A trickle becomes a flood. A sell-off becomes an exodus. And the US bond market, already under strain. Foreign participation in US bond auctions has fallen from 72% to 57% in just a year. Why? Because nobody wants to buy into instability. May marked the first monthly loss for US Treasuries in 2025, down 1.2%. Long-duration bonds are now showing a cumulative 7% loss since 2020, even when accounting for coupon payments. That's catastrophic for banks. According to Federal Reserve data, regional US banks are sitting on $413 billion in unrealized paper losses, nearly double the figure at the time of the SVB collapse. These banks are being forced to absorb new Treasury issuance because foreigners won't touch it. But they can't mark those losses to market without triggering panic. So they hold. And they bleed. Quietly. Now let's talk about Trump's big beautiful bill. Buried in that legislation is Section 899. It's a vague clause that gives the Treasury unilateral power to impose higher taxes on foreign investors from countries deemed to have unfair taxes. Against the US sounds harmless. Think again. According to JP Morgan analysts, it could hit allies like France and the UK, especially those with OECD-compliant digital service taxes. The optics? Horrible. The timing? Even worse. The Treasury needs to auction $300 billion in debt this quarter. But if you tell investors you might trap their capital with punitive taxes, what do you think they'll do? They won't buy. They'll run. So what happens when America slaps tariffs on Europe, revokes tech licenses from China, threatens capital controls, and still has to beg investors to buy more debt? You get a crisis of confidence. Not someday. Now? The Geneva truce was supposed to be a reset. But 3 weeks later, China hasn't followed through. No easing of rare earth controls. No trade acceleration. Just silence. Meanwhile, Trump is back to threatening Europe with auto tariffs. Consumer spending is down. Student visas are being revoked. Chip firms are being frozen out of global supply chains. This isn't a trade dispute anymore, it's an ideological fracture. As Reuters recently reported, China's Ministry of Commerce is now urging the US to correct its wrong practices. That language. It usually precedes retaliation. Ask any analyst. We've seen this playbook before. So what breaks first? The bond market? The dollar? Or the illusion that Washington still holds the global financial reins? This isn't just about economics. It's about psychology. Trust once broken is almost impossible to rebuild. And right now, the US is running on borrowed trust, borrowed dollars, and borrowed time. If you think this isn't sustainable, drop your thoughts in the comments. What happens if this standoff becomes the new normal, not the disruption? Because from where we stand, the crash might already be in motion. If you found this breakdown valuable, make sure to like, subscribe, and hit that notification bell so you never miss the stories the headlines won't show you. The next policy decision might not just shake markets, it might shatter the entire system.